Hi there, my name is Harmeet Sangha, and today I'll be discussing unsecured loans versus unsecured line of credits. Let's get started. Right off the bat, these products are available to Canadians that require the use of borrowing money to fund specific purchases in their lifetime. These products here are available at all Big Six banks in Canada, as well as private lenders and credit unions. Now, before we dive into the features and the characteristics of line of credits and loans, we must understand exactly what is unsecured lending. Now, individuals need to borrow money for many different reasons, but sometimes there are people who do not have the ability to put up a house or any sort of physical asset as collateral. So essentially what happens is it results in a verbal agreement between the borrower and the lender that the borrower will promise to pay back either a portion or the full amount of the money that is borrowed. Now, this puts the lender in a little bit of a risky situation, but this is when a couple things happen. Number one, the lender will assess a client or a borrower's credit worthiness, which is essentially their past history and their past use with credit, as well as their ability to pay that back. And secondly, this results in a little bit of a higher interest rate for the individual that's borrowing the funds. So now that we understand what unsecured lending is, let's get into the features of loans and line of credits. Starting off with unsecured loans. Now, what makes a loan is that it's also known as an installment credit, which is a one-time need for credit to fund a big purchase for an individual. Now, the payment structure of a loan is through scheduled fixed monthly payments, including a combination of the principal and the interest amount. The full money owed back is eventually paid off. Now, the time that it takes an individual to pay off that interest as well as that principal is known as the amortization period. And this feature is solely specific with a loan. Now, if we take a look at which type of individuals require loans, like I said, this is for one-time uses of credit, and it may be needed to fund large purchases. Typically, these purchases are over $30,000. For example, it could be the purchase of a new car or a new yacht, or possibly to consolidate a large high-interest debt. These individuals that prefer loans also prefer lower debt payments because of them taking advantage of the larger stretched out amortization period. They can have lower debt payments. Let's move on to unsecured line of credits. Unsecured line of credits are also known as revolving debt, and they act very similarly to credit cards because of a client's ability to use a little bit or a lot of credit over a person's lifetime. Now, the borrower and the lender, they come to an agreement on a maximum amount of credit that an individual is able to use, and this is also known as a credit limit. Now, the borrower may use a portion or the full amount of the credit limit on and off over their lifetime, making sure though that the payment structure is made properly and doesn't have a tendency to miss payments. Let's get a quick example of an individual with a line of credit. We have Jim here, who just got approved for a $5,000 line of credit at his bank. Now, a few days after being approved, Jim goes to a mechanic and needs to fund the purchase of new rims, new tires, and a new paint job for his car. And these expenses total up to $5,000. Now, if a few days after those purchases, Jim goes and pays off the entire balance of that line of credit, that next week, he can make purchases of possibly a new interior or a new sound system in his car, and he has access to the full credit limit again after paying off that full balance from before. When it comes to which type of individuals would prefer line of credits over loans, these are the individuals that need to fund smaller projects or smaller purchases, specifically a new vacation possibly, or renovations spaced out over time, or day-to-day spending. This needs for credit are typically lower than $30,000. And that sums up the presentation. So in summary, in conclusion, some of the differences between loans and line of credits are the need for money. Specifically with loans, those are for one-time uses of credit totaling up to over $30,000 of purchases. And for line of credits, it would be under $30,000 for small needs, maybe periodic needs over their lifetime. When it comes to loans, the payment structure are fixed monthly payments over an amortization period. Whereas for a line of credit, the banks and lenders offer minimum payments for the borrower, which is typically around 2% of the remaining balance. Those are some of the features of loans and line of credits. Thank you so much for listening to my presentation. I hope you learned a little bit more about loans, unsecured lending, loans, and line of credits, and are comfortable with talking to bankers and talking to financial experts about these products. Thank you so much, and have a great day.